Hi there, this is Justin Krane, Certified Financial Planner Professional and founder of Krane Financial Solutions. Welcome to Money You Got This. So how can you really live? How? By uniting your business money, your personal money with your life and your business. Word up.
Krane Financial is an SEC-registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. A copy of our current written disclosure statement discussing our advisory services and fees is available upon request. Information contained herein is for informational and illustrative purposes only, and general in nature. It should not be considered specific financial planning or investment advice, or a recommendation to buy or sell any type of securities or other investment products.
What is up, everybody? This is Justin Krane. Welcome to Money You Got This. I am super psyched for this show. I'm not going to tell you why right now, but I'm really, really psyched. Let me just say this. This show right now brought to you by Krane Financial Solutions. I'm Justin Krane. I'm a certified financial planner professional. Say that like 92 times fast. It's very hard. Where am I going with this? Well, I offer investment management services and act as a fractional CFO to dentists and business executives. I'm the author of the book, Money You Got This, and it's time to merge your money with your life. You guys ready? All right, let's do this. I'm psyched you're listening to the show. I want to give you this free report, 3 things multimillionaires do to grow their wealth. Just go to coolmoneyshow.com to grab it. That's coolmoneyshow.com to grab it. Thanks. So today's guest is a good friend of mine. Her name is Melisa Silverman. I'm not even going to give you her bio. I'm not even going to tell you what she does. All I want to say is I am bowing down to one of the smartest people I know, one of the most connected people that I know, who, if you guys will just listen, give it like half hour, 45 minutes, you're going to learn a lot. Melisa, welcome to the show.
Thanks so much, Justin. It's so great to be here.
Cool. All right, so let me tell you guys like who she is and why you need to be listening. So Melisa is in the valuations arena and the consulting arena. So she is president of Avenue M Advisors, which is a national business valuation firm. She also is a partner in the Founders Group, which is a consulting firm that helps businesses with transition planning, and she advises them on what to do to grow the value of their business and way more. She's a certified exit planning advisor through the Exit Planning Institute. She's a certified valuation analyst. She's a certified friend of mine. She's also a senior business analyst through the International Society of Business Analysts. She's all about valuation and smart business strategies. So that is my long-winded bio. Welcome again.
Thanks, Justin. It's
Cool.
So great to be here.
Thank you. Thank you. So let's just start off with like the first simple question, which is really, why does someone, now I know this is obvious to you, but a lot of people listening might not know that they should get a valuation on their business. So can you talk a little bit about what is a valuation and why a business owner should have one?
Sure. Let's jump in. So a business valuation, all it really is an opinion of value of what a business is worth, but it's performed by somebody or by a professional who has the experience and the expertise to value that type of business and understands the markets and understands how to put a value on that type of business. That's what a business valuation is all about. Now, the way we get there is a lot more complicated than hopefully what I just made it sound like. But the reason that a business owner wants to have and should have a business valuation done before they do anything with their business is because you want to have your own independent idea of what is your business worth. You started your business, you might be running it for 5, 10, 15, 20 years, and you probably think that you have a very good idea of what your business is worth. But I can tell you that the way businesses used to be, where it was all brick and mortar and it was a lot of fixed assets and inventory and all that, that's not the way most companies are today. Most companies are comprised of intangible assets, things like software and copyrights and patents and trade secrets and things that you can't just put a value on the same way that you could years ago. But those things have a lot of value in a company. So as a starting point, you should have a valuation done just so that you know, as a starting point, what is your business worth?
Yeah. I see a lot of clients that I work with. They're like, I don't need one. Like, whatever. It's like, who cares? And they're doing like multi-million in sales, like crazy. And they're like, whatever, I'm not selling. It's not just so that you can sell. It's like, don't you want to know what your business is worth? And then don't you want to know what you could do now before you actually want to sell it to make it worth more? Like, I'm pulling out my wine mic here. I'm literally pulling out my wine mic on this one because I see this so much, and I'm sure I'm like preaching in the choir because you probably hear this a lot too. It's like, just because you're getting a valuation doesn't mean you're selling your business.
That's correct. So a lot of business owners get a valuation done because, many companies have a lifestyle type business. Their company is cash flowing, and it's giving them off the cash flow that they want. Mm-hmm. But, you always have to be thinking about the 5 Ds, divorce, distress, death, disagreement. There's all these reasons why an event could happen to a business owner, and you may not be prepared for it. And what do you do with that business? Do you lose all the value in your business, or are you prepared for it? And are you ready to take, or for somebody to take that next step of what to do with your business? But in addition to that, getting a valuation done on a company allows you to understand what that value is at now. And if it's done properly, you're going to have a list of the weaknesses in the company, and you're going to have a list of the strengths in the company, so that that business owner can go and focus on the weaknesses and turn those weaknesses into strengths. And by doing that, you're building value. So you're increasing the value of your business. It's just good. It's good strategic business strategy. It's what every business owner should be doing.
And also, like, when people grow the value of their business by doing the things that you're recommending based on the valuation, what I've seen is that the valuation can go up by a lot, not just by like a few percent, but it can go up by a lot if they're doing like 3 or 4 things that you're recommending or the valuation finds. I oftentimes think that business owners are like, okay, I can do that, whatever. But like, if you do those things and your business is worth a lot more, like, I'm looking at it from a financial standpoint. A lot of times when I do retirement plans with people, I'm like, if your business sells for this, you can do all of these things. If it sells for this, you got to work a little bit more, or maybe you have to have a back end plan. But I just think that that just because you're not selling doesn't mean you shouldn't have a valuation, number one. And number two, once you have one, like you're saying, you can like take action and implement all of the things that are coming up in that. So can you talk a little bit about the process of getting one? Like, what does a business owner have to do? How much work do they have to do on their end versus it's all you? Like, do they just sit down with you and do you interview them for a few days and look at their financials? What's the process, soup to nuts?
So the first thing is, when we do evaluation, we want to be as non-obtrusive to the business owner and to the business as we can be, because we don't want to take away and impact the business. So what we do is we provide the business owner with what we call an information sheet. Some people call it a questionnaire. And on that information sheet, it has a list of all the documents we're going to need to receive to review. It also has a list of questions about the business, because the business owner, they're in their business. They know their business. We know the markets and we know how to get at the value of the business, but we need their help to understand their company. So we have them provide us with all the documents and provide us with answers to those questions. And then we go, once we receive all of that information, we'll get started on the valuation. We'll review it. And if there's a reason to meet with the business owner and to do interviews, we will do that. Some types of valuations that we do require interviews. If we don't need to do an interview, we'll go ahead and we'll get started. And as we're getting into the analysis, if we have questions, we'll start coming back to the business owner and start asking some questions and getting some clarification, because the analysis has to look correct. So we'll come back and forth with questions. And once we receive everything, then we complete the analysis. And then from there, we'll go ahead and write up the valuation report, and we'll provide them with a draft copy to review.
So I've heard, like, anyone getting their business valued, they're going to want to know the number. Like, what's the number? What's the one number? But I've heard people mention that you're very thorough with your work and that you can give like a full on like 50, 100-page report that's basically backing up that one number.
Yes.
So,
but you do get the number in the first 5 pages. I can tell you that.
Okay. So there's 95 pages of fluff, 5 good pages?
Not fluff. All required information.
Back up, yeah. So do you find that when someone gets a valuation, that the valuation is higher or lower than they thought it was worth on average?
It depends on what the purpose and the use of the valuation are for. So let me explain that. So the purpose of the valuation tells us what it is that we're doing. So for instance, if a business owner is looking to sell the business right now, they're looking for a high value. So we know that we're going to try and be on the high side of the range versus being on the low side of the range, because there's always a range of value for a business. If somebody is looking to put, let's say, a stock option plan in place, and they're looking to give options to their employees, at some point in time, they want their employees to be able to exercise and to buy those options. If the per share price of the shares is too high, the employees will never be able to purchase those options. So in that case, we want the value to come in on the low end of the range. So depending upon what the reason is that we're doing the valuation, that's going to tell us if we're going to be on the high side, the low side, or right in the middle. If we're doing an ESOP company, ESOPs are only allowed to purchase shares for fair market value. So we know that we're going to be right in the middle of the range when we're doing that. So again, the purpose tells us where we're going to be, and we try to do that.
So you talked about a sale, an employee stock purchase plan. I'm sure if someone dies for estate planning, you got to do one. Maybe
that's typically on the low end. If it's a charitable contribution, they typically want to be on the high end.
Got it. And then what about, I mean, this is a vortex, that the whole buy-sell agreement, 2 people owning, all of that. I mean, I personally think that a lot of business owners that do have partners haven't really planned out their sail off into the sunset, either how they're going to do a buy-sell, how they're going to sell it, what's going to happen if one leaves, what's going to happen if one works less. There's so many moving parts. But I would think that if one partner wants to buy out the other, they would want to get an independent valuation, right?
Yeah, they should. And they should fund, if they're going to put a buy-sell agreement in place, they should fund it so that they have the insurance or they have the funding that should an event occur and you need to buy out the other partner, that you have the funding to be able to do that. What we see often is that partners will talk about putting a buy-sell agreement in place. They do put a buy-sell agreement in place. They typically don't get a valuation done, and they typically don't fund it. So if an event occurs, they don't have that financing to be able to buy the other partner out. So those are the 2 things that if you're going to put a buy-sell agreement in place, make sure you get a valuation done, because you want an independent value. You need a starting point. Yeah. Because you need to know how much financing do you need or insurance do you need to get to cover it. So, and typically those are just going to be in the middle of the range. Yeah. You want the higher or the low side, you just want to
for the buy sells, should the owners get a valuation every 2 or 3 years? How often is a valuation good for in this case, and I guess in general too?
So in general, evaluation. So according to the IRS, evaluation is good for up to 12 months. However, the caveat is if there are any substantial changes in your business, or if there are substantial changes to the economy or the market, any of those things, then it requires that you have another valuation done. So typically valuations are usually good for 6 to 12 months.
Got it.
Depending on what's happening with that company. If they're going through hypergrowth, then they're going to have to get a valuation done more frequently, because it's just not going to hold up. But if nothing's happening, no changes are happening, then it'll usually hold up for about 12 months.
So we have this valuation, and we're like, okay, cool. My business is worth $10 million. And then they go to sell it, and there's no buyers at 10 million. They're only at 8.5. So can you talk a little bit about your independent valuation per se, and then what the market is willing to pay for something? How does that work? Does the valuation then get moot, or is that just a starting price? that people can look at to list it? How do you take the market price? Like even for home ownership, you got an appraisal and then you got what it sells for.
So I always tell business owners, if you're having a valuation done for sale purposes, it's a baseline valuation. Okay, this is showing you what the business is worth right now based on the markets, the current situation of the markets, but also based upon your company's performance. And is it outperforming against the market or is it underperforming? So based upon how your company is doing, you might, now I'm going to throw out two terms and I'm going to define them because these are important terms to understand. The first one is called EBITDA.
I love that.
EBITDA is earnings before interest, taxes, depreciation, and amortization. Typically, a business will sell based upon a multiple of their EBITDA. Now, the second term I already threw out, which is multiple. A multiple is it's a factor that is used to say that this is how well your business is performing. So if we use, let's say, average, depending upon the type of company, an average multiple might be anywhere from 3 to 5 times EBITDA. And so that's what your company would sell for. If a company is doing really well, and there are some industries that are doing really, really well, then you might have a multiple of, let's say, 7 to 12, or it could go even higher than that. That is your business is going to sell based upon a multiple of your EBITDA. And your EBITDA, just to explain it a little bit further, is your normalized earnings in the company. So what that means is we take your earnings so we take your income statement. We typically will look at 3 to 5 years of your income statements, and we're going to weight them based upon each year and which ones are the most important. And we're going to be normalizing them. So what we're doing is we're adding back things that you're running through the company that are personal in nature, or we're adding back other things that are non-recurring. So let's say you acquired a business. Yep. You don't acquire a business every year. So we're going to add back some of those costs for doing that. So we're looking at what adjustments are we making to the business so that we can come at, or we can determine your normalized earnings. So that's what we're trying to get at, is what is the multiple for your business that it's going to sell for. Now, when we do evaluation, we're determining a baseline value for your company. That doesn't mean that that's what your business is going to sell for. What your business is going to sell for is what you're able to negotiate with a buyer in the market. Yeah. However, the valuation report, you talked about how long our valuation reports are, 50, 100 pages. There's a lot of information in the valuation report that you should be able to use, if you understand it, to negotiate with a potential buyer. Yeah. It gives you a lot of the information you need to make very persuasive arguments as to why you have the purchase price that you're listing the business for.
Thank you. I am knee deep in EBITDA craziness all the time. Let me, that was a very, very good explanation. I'm going to actually try to simplify it even more. Please. From what I've seen. And you correct me if I'm wrong, but I want to make sure that people get this. So you take what your business makes, its net income. And then what you need to do is, if you're running some personal stuff through the business, you need to add back that money, because if you didn't have those expenses in your business, your net income would be higher. So we're now going to add back those personal expenses. So now your business is actually making more to a buyer. Then for 1 year, you might have bought, I don't know, a pen that was worth $100,000 that you're not going to buy the same pen every year. So that gets thrown out. Then you have this EBITDA number. Then you multiply it by this 3 to 5, generally, ballpark-ish. That's your valuation.
That's the value.
All right, cool.
That's your starting value.
Yeah, that's like,
that's the value. That's an enterprise asset value for the business.
Yeah. That's
not the equity value of the business. I want to make that clear. Okay.
Well, why don't you talk about that? Why don't you talk about the equity versus enterprise? What does that even mean?
So enterprise asset value is, if you were just selling the assets in the business, that's what that value would be. Mm-hmm. And that looks at your fixed assets. plus intangible assets, plus other assets. So that's what that number is taken into consideration. But if somebody is selling the entire company, they're selling the stock in the company, then we have to, after we determine what the enterprise asset value of the business is worth, then we have to make some adjustments to the balance sheet and bring everything from book value to market value. And that's where we include your intangible asset value. So there's goodwill value, and there's also intellectual property value. We add those, we're going to include those values on the balance sheet. There might be some contingencies that we have to account for. So we're going to make, you might own some real estate. So all of these things, we're making adjustments to the balance sheet to bring everything from book value to market value. And then that determines what your equity value in the company is worth. And we're deducting out all the debt and everything.
So what are some things, just general? I know it, like, I just want people to know that, like, they should have a valuation, and that, here's the kicker, that there's some things that they can do now to increase the value of their business. What are some common things that you think that business owners can do to either increase the value in their business, or what are the mistakes that business owners are making that is holding back that value and making it worth a lot less?
Oh, that's a loaded question. Let's.
I know you can go in any way, but like, what are the common things that you see business owners do that really inhibit that valuation, make it less than what it could be worth?
Sure. So let's talk about some things that they can do. So things that we typically see business owners that where they should start. The first thing that you want to do is you want to de-risk your company. So what I mean by that is you want to make sure that you have the proper insurances in place. You want to make sure that you have the protections in place for your contracts. Make sure you have contracts in place with your customers, with your employees. I can't tell you how many times I see that companies do not have any contracts in place or offer letters or anything in place with their employees, but yet they have all this IP in the company and they're not protecting themselves from having their employees go off and sell it to somebody else or solicit other, be solicited by other companies and non-competes and all that. You want to make sure you have all that in place. You want to make sure that you have a really strong management team in place. Buyers are really interested and they want to be impressed by your management team. So if you don't have a management team in place, and if a business owner is not able to take time off and do other things, that's going to decrease the value of it.
I see that a lot. Like, what are you buying? Like, well, if you're buying a business where it's just one person who's responsible for everything, what's the business worth if that person isn't there?
It's not worth very much.
Yeah.
Yeah. Another thing is make sure that you're looking at your financial reporting. First of all, do you have your finances in place? You know, are you looking at it? Are you looking at your profit and loss statement? Are you looking at your balance sheet on a regular basis? If you're looking to sell your business, do you have audited financials? Typically, it's not necessary, but a lot of times potential buyers want to see that you've had an audit of your financials done, and they want to see that they're clean. If they're not clean, if you are running all these things that are personal through your financials, you need to clean that up, and you need to do it ahead of time before you sell a business. Because a buyer is going to decline. When you get into due diligence, a buyer is looking for all the reasons that they can start to bring that purchase price down.
So audit is like a third-party CPA firm that has no affiliation with who you're using to do your books or your own taxes.
Yes. And if you can't have an audit done, then at least have them reviewed. Have a CPA firm come in and review the financials and make sure that somebody's looking at them.
Okay.
Yeah.
So we have contracts with employees. We have audited financial statements. We have insurance. What else?
So some other things that you want to look at are your customers. How about your customer? First of all, look at your revenues. Are your revenues trending up? Are they trending down? What has it been over a period of time? And do you understand why it's doing that? So you need to understand what's happening with your customer base. Do you have a pipeline in place? Is it a long pipeline, or do you not know where your next customers are coming from?
I love this. I love this. Can I go with a small rant? Just a very, very small rant.
Please.
I wish that business owners would look at the well, let's say it this way. I want businesses to diversify their revenue streams and not depend on one client or one source of sales. If that source goes away or those two clients go away, your business is worth like way less. Like,
way less. Yeah, it's so important. And then you have to look at, do you have reoccurring revenues? Are you in a situation where you have reoccurring revenues, or are you in a situation where one client is 90% of your revenue? I have an example of that. I do have a client where one business is it's more than 90% of that business revenue. However, the reason, and that when you have that situation, that is a huge customer concentration issue.
Yeah.
Buyers are going to decrease their price.
For sure.
Really going to decrease their price because of that. But in this situation, this client situation, while they have one predominant client, they work with different buying groups all around the world. And because each of the different buying groups are all independent of each other, if they were to lose one buying group, they won't lose all the rest. So it's not like the one client is going to go away. So in that situation, that's a situation where you can't treat that one client as one client. You have to look at each of the buying groups as different clients. But you don't have that situation that often. So you really have to look at it on a facts and circumstances perspective and see what's going on in that business.
Great. This is great. I mean, we could talk valuations all day long, but I want to transition into what you're doing with the Founders Group, but I want to come at it at a different angle because I want people to see how you, Melisa Silverman, have evolved. I think it's a similar path as to how I have, because you worked in-house at like 2 or 3 companies, right?
I worked in-house at several technology companies, yes.
Yeah. And then you left to start your own consulting firm.
So I left the technology world, and I was recruited. When I left the technology, I was doing. I was on the corporate side of doing transactions. So I was reviewing a lot of the due diligence, and I was integrating companies and all that. I left to go to. I was recruited to a boutique valuation company, where I learned and got my experience and my designations to do valuations. And then I started my own company.
Then you started Avenue M, right?
Correct.
Okay, so you're at Avenue M, and what you're doing is all of these valuations, doing good work, but then you're seeing that there's so much more that can be done to increase the valuation and work with clients like before, during, and after the valuation, which, right?
So what I found in doing the valuations is when we do these valuations for companies, and a lot of times it's for a company that's looking to sell, we see very clearly in the valuation that these businesses are not ready for sale. There's a lot of work that needs to be done, but yet they're going to market. And so it was really important to me to be able to not only do the valuations, but then to be able to help these business owners be able to make the improvements to their business so that they could make their business more valuable, they could make their business more marketable, and give these business owners options as to what can they do with their business.
So now you're going from working and getting paid for one scope of service evaluation to now doing ongoing work, which could be recurring, depends on the situation, another stream of revenue, and is simply an evolvement, if that's a word, of what you're doing. It's kind of like what I do. I started out as a CFP, and then as my business grew and I saw a new need, I rolled with it in being a fractional CFO while maintaining the same, same original source of income. So now you're diversifying your revenue, you're actually helping clients, and you're doing more with it.
Yeah, exactly.
And you're not doing it all by yourself.
No, I have 4 other partners in the Founders Group. It's not just me. 4 different multidisciplinary skill sets in the Founders Group.
So this is pretty cool. Can you talk about your journey leaving corporate to starting out on your own to doing the Founders Group? How was that for you? Was it scary? Was it fun? Was it cool? Was it like anxiety producing, or was it like, okay, I'll do it and we'll see what happens?
Well, let me go back even a little bit further than that, because what you haven't touched upon is the fact that I also have a legal background.
That's
So,
right.
yeah, so I have a legal background,
Yes.
decided not to practice, went into corporate and worked for several technology companies. I did all ranges, small, medium, and large size companies, and then made the transition into doing valuations, to the transition to being my own, to being a business owner. The evolution has been wonderful. I feel like everything that I have done in my career led me to that next step. And everything that I've done has just been, it's been at the right time, it's been with the right people, and it's been for the right reason. And
Isn't it so cool to be congruent and growing and succeeding all at the
yeah, it doesn't happen that often, but when, you know, sometimes the everything aligns well,
Yeah.
and you just know that it's the right thing. And for me, it was the right thing. And I haven't looked back at all. For me, I just keep looking forward, and I'm like, what is that next thing?
That's
Now,
so
I'm
good.
hopefully I'm at that next thing, and we'll stay here for a while. But there's so many opportunities, because if you take a look at the demographics and how many business owners in the next 5 to 10 to 15 years are going, because of all the baby boomers and how old the baby boomers are, and they all have businesses, there is going to be a lot of transitioning of businesses, whether it be to their kids, to partners, to their employees, or whether they sell the business. They're going to have to do something.
Sure.
And they only have a few options. You can either continue operating it the way it is and wait for something to occur, or you can plan for what that exit might be and be ready when, you know, and be ready with the potential of having options that are available to you, which is a good place to be. Or you can just continue to run your company and potentially be on the back end of it and you know, go through a decline or have to shut your doors. And that's not where business owners want to be, because most business owners have 90% or more of their wealth tied up in that business. So you really want to plan for the exit or the transition of your business so you don't lose that wealth. So important.
Yeah, no, I look at it all the time. It's the one variable. It's like the business sale. What's it worth after tax, and when, and you know, all that kind of stuff. So, I don't know. I just think what you're doing is great. I believe in this evolvement of what you've done. I think it's amazing. Where can people go to find out more about either Avenue M or the Founders Group or any of the events that you're putting on?
So, so we have websites for both companies. So Avenue M is avmadvisors.com.
Is that AV or AVE?
It's avemadvisors.com.
Okay.
So I just shortened Avenue. That's all I did. And then the Founders Group is actually foundersgroup.biz. So it's a little bit different. And on the Founders Group, there's a lot of information on the Founders Group. So you can just go and read. You can give me a call. You can send me an email. All my information is on the websites, so you can get my information. I'm happy to talk to anybody and answer any questions that I can to help you. We put on events on a monthly basis. So we have an event coming up on June 6th. It's the first Thursday of every month, called Community Insights. And these are business events. So these are for business owners that are looking to become educated on exit planning. You can attend one of those events. I'm also the president of the LA Exit Planning Institute chapter. And that chapter meets on a monthly basis. We meet on the second Thursday of every month from 7:30 to 9:30. And we always have an educational program.
Yeah.
So you can come, and if you want to learn on all aspects of exit planning, we take a holistic view of exit planning, so you can come and learn about different aspects. And once a year, we also put on a business owner event. So this past week, on Tuesday of this week, we just had a business owner event where we had about 100 business owners, or a little more than 100 business owners, come to a location where we educated them for a morning. We had 4 panels that discussed all different aspects of exit planning and what do you do to grow your business and to make it more marketable and get ready for the exit. And then we had at the tables, we also had questions that we asked them, and we had table discussions, and the business owners were really, really engaged, and they loved the questions. And then we ended it with a business owner panel where we had 4 business owners that came and talked about their exits and what they went through and what was some of the advice that they would give to the business owners that were in the room. So we do that at least once a year as well.
Very good.
So we're all about education.
It's been great to have you on. You're a wealth of knowledge and information, and I really want to encourage everyone for listening in. Go to the sites in the show notes. Reach out to Melisa. We'll put all of her information in there, and it's just been great to have you on. So thanks for coming on.
Justin, thank you so much. This has been wonderful. So you're amazing. So if you're not working with Justin, you should be. Give him a call.
Thank you. Have a question? Want to get in touch with us? Need some help and advice with your finances? Just go to coolmoneyshow.com and reach out to us. That's coolmoneyshow.com.
Krane Financial Solutions is an SEC-registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. A copy of our current written disclosure statement discussing our advisory services and fees is available upon request. Information contained herein is for informational and illustrative purposes only and general in nature. It should not be considered specific financial planning or investment advice, or a recommendation to buy or sell any type of securities or other investment products. No investment decision should be made based solely on any information provided herein. We do not provide legal, accounting, or tax services. We recommend that all investors seek out the services of competent professionals in any of the aforementioned areas. Certain information provided has been obtained from third-party sources that we believe reliable. However, it's not been independently verified and is not guaranteed.